Jason, are we going to get any clarity out of Jackson Hole next week?
I think broadly speaking, in terms of Jackson Hole, I'm sure that there will be a lot of headlines coming through. But I think if you look at the broader picture into September FOMC, do remember that when we looked at the CPI in the last print, although you can say that it was slightly better than expectations, the bottom line is the nominal CPI is actually still very, very high. So I think within that context, looking at what the Fed speakers have been mentioning in terms of comments, it's almost as if 75 basis points hike is actually sort of an insurance of sorts to make sure that at least some of that inflation that gets further under control in the coming cycle. So I think with regards to Jackson Hole, lots of headlines, but at least from where we think of it, and you look at market pricing, 50 to 75 basis points is pretty much baked in the cake for the upcoming FOMC. I think what's more important then is how are the dot plots, what are the Fed thinking afterwards, and how does that affect the projections of the future rate hikes? Because as it's currently expecting 75 and then possibly 25, 25 or 50, those would be some of the levels which I think the street is thinking at. So there is some dependency after the September FOMC, but the bottom line is for the near term, I think the hike there is pretty much priced in and well expected and televised.
Yeah. Maybe you see that in the MOVE index, where bonds are certainly getting a bit more calmer. People are returning back to the bond market right now. How sustainable are these moves? And does it give you more inclination to maybe add duration now in this market?
So I think with regards to the US Treasury side, we've been operating within this region more as a range trade of sorts, to be honest. I think what is noteworthy, of course, then is the 210s curve inversion in the US. We've actually never been that inverted for quite some time already. And arguably, the current levels are already worse than the 08s of the world. So I think within that overall curve invergence scenario and pricing of recession risk, I think that if you pair that towards the Asian economies and some of the data points that we've been getting, and also some of the monetary policy comments coming from the central banks in this region, we do think that there is a window to engage, at least tactically, for some of this duration, and possibly maybe as a more secular position into next year.
Jason, in just a span of just 1 month, 10-year Treasury yields have dropped at least 60 basis points from that high of 3.5%. Would you say that any move upwards in terms of 10-year Treasury yields is a buying opportunity?
So I think overall, as what I was mentioning in terms of the Fed pricing and the market's pricing of the rate hikes in the September FOMC, if the bulk of these hikes are priced in, even if the Fed does the 75 as expected, you might see a marginal or slight sell-off in US Treasury 10-year from here. But whether it would necessarily hit a net new high or a new peak on US Treasuries, I think that remains somewhat contentious. Because again, it goes back to the point that at the end of the day, there is another 50 to 75 basis points hike coming through, and that will impair or impact parts of the domestic or consumption demand. So naturally, then that should provide some degree of CPI normalization over time, at least from the US side. So I think to me at least, then if that's the case, I would probably consider more of this as a buying opportunity. Although I think that in some sense we have seen a very decent value creation within the Asian rates. So our expressions within the Asia fixed income naturally leans a bit more towards this region over specifically being big overweight US.
If you are chasing high yield, would you be buying China?
Oh, did you mean China US dollar credits? So I think within the US dollar China credit space, as you know, there's been some degree of value creation, not only in the property sector, but the banking sector as well. A lot of this is top-down policy driven. And of course, there are certain bonds right now that trade at more distressed levels. I think to be very honest, within this sector, although there's value creation, a lot of this is driven by the top-down policy drivers. As such, we need to look at A, whether there's a turnover or turnaround in terms of the big policies. I don't think we've seen that thus far. And B then is the bottom-up selectivity. So I think it's not as easy as saying it's a buy or a sell. I think it's more about picking those battles and trying to assess which ones will survive. And we would use those as the buying opportunities over time.
Yep, and you said constructive on Asia rates, selective when it comes to FX, though. Can you elaborate a little bit more on that thesis and where in FX is most vulnerable at the moment?
So I think the message that we've seen over the past year has been that the Fed has been very hawkish, and Asian central banks, as you know, some of the North Asian ones in particular, as well as parts of the Southeast Asian ones, have become more hawkish to compensate or match that of the Fed. But I think something's been changing over the past quarter or two, in particular as the market has increasingly priced in the Fed rate hikes. And we're actually seeing some marginal improvements in headline CPI in the States. This has actually provided some changes here on the monetary policy stance for some of the Asian countries. So we've actually started seeing some of the ASEAN central banks becoming slightly less hawkish than before. And because of the fact that the rates have sold off within this space for quite a bit, we actually think that this change in stance over time, particularly into next year, may allow for some buying opportunities for the Asian local duration. As such, then, on an overall basis, we generally like the Asian duration. We are positioned selectively in Indonesia and Malaysia in particular. For the other countries, then I'd say that we're a bit more tactical.